We are super excited to kick off the workshop for tonight. Before we begin, as always, I want to go over some housekeeping rules because this is a larger group. I'm going to request you to please keep your mics muted during the session. However, if you have a question, please put it in the chat function. I will be moderating it and bringing it to our facilitators' attention. We will be stopping at particular sections to take any questions. And then, of course, we have dedicated Q&A session towards the end as well. And now, without any further delay, I would like to introduce our amazing facilitators for today's workshop on understanding business taxes, Cecile and Amir. Cecile is a CPA and senior manager in the Business Tax Incentive Group at EY, specializing in the scientific research and experimental development program. She has worked with clients in a variety of industries, including agriculture and food processing, biotech, IT, manufacturing, clean tech, carbon capture, and oil and gas. Cecile, thank you so much for joining us today. And joining Cecile is Amir, who is a partner in EY's tax group and focuses his time advising Canadian private companies and their shareholders. Amir's practice covers a broad array of Canadian income tax matters, including corporate, personal, and trust taxation. He also provides tax planning advice for Canadian and international clients on reorganizations, intergenerational transfers, and estate planning. Amir, thank you so much for facilitating and leading the workshop today. And I invite you both to begin the workshop.
Excellent. Thank you so much for that introduction, and welcome everyone to today's workshop. I know Alina's just going to be switching over some slides, so as she's doing that, I'll just stall for a little bit and just kill a bit of time. And so, yeah, Cecile and I will be joining you from EY. We practice primarily in the Toronto region, and oh, good, slides are up. And so we can get started. So again, we have an interactive session today. We've got some deliberate polling questions to just get some audience engagement, but also to gauge your understanding and knowledge of certain topics, which may be derived from friends, family, your neighborhood barber, the internet, Google, those sorts of things. And so really also part of today's session is a bit of demystification of, how do these things actually work? So as Lena articulated already, feel free to put your questions in the chat. We will be pausing after certain topic areas to really have any questions and deal with any questions on certain topic areas. And as you come up with questions, feel free to type them in the chat. We may not field them right away and just wait for the next natural pause. But I find, as questions come into your mind, unless you write it down, I certainly forget it. So feel free to put them in the chat. Okay. Without further ado, so our agenda, we've got 5 items to talk about today. We've got Canadian corporate tax basics, so primarily income tax, same thing for filing and payment deadlines, sales tax, payroll tax. Cecile will take over with tax incentives, and then I'll finish with US expansion considerations. And certainly for the US expansion considerations, not to step on the other presenters' toes for tomorrow, but really any international expansion, and also and specifically how would one structure and think about the taxation of an international expansion. Okay, so I think we're up to our Canadian income tax and first polling question. And really it is, who has a corporation for their business activities already? Again, wanting to get a feel for the group, what people have done, what people are doing. So feel free to put your answers in the poll, and we'll go from there. I bet Cecile I had a feel for what the percentage should be, so we'll see how it turns out.
So Amir and Cecile, just to confirm, you're able to see the poll, right?
Yes.
Okay, awesome.
All right, we're about 60% participation. I think Alina will give folks just another 30 seconds or so. So poll open for a minute, and then we'll close it off and we will see where it lands. Excellent. I think we're up to about 75% participation. So that's great. My prediction is almost true. All right, I think, Alina, we can close the poll. And then do folks get the answers? Or we can share them. but I had a guess of it would be about 50-50. And I think once people can see the results, it's about 60-40. 60% of people do, 40% of people don't. So it's actually pretty good breakdown. And I knew it wouldn't be 100 one way or the other, but that's about consistent for a broad group of founders. It's about 60-40, 50-50, somewhere in that range. Okay, that is excellent. And so the next polling question, just to give me a feel for, why. And again, part of that demystification purpose of today's session is, the why. And so what's the reason you have or would have a corporation? One, save on tax. Two, limit legal liability, and pick the best one that most applies to you. Your friend told you it was a good idea, and you don't want a corporation. And I know how many people are in that bucket, but for the folks who do, I'm curious as to the reason. Um, because again, the reason could be different for a lot of people. And certainly today we'll be talking about the tax part about it, but I'm just curious to see. Also appreciating that the accountants are later in the series, and I think the lawyers already got to you. So I have certainly there's a big swing towards, or a preference towards, limit legal liability, option number 2, not giving it totally away. We have most people participated now. If we can close in about 10 seconds or so and share those results, that would be great. But a vast majority of people are selecting limit legal liability, which is true. Only 20% of you are saving on tax, which is also true. A couple of folks said his friend was a good idea. Not going to lie, that it's on there because it actually does get some hits, and a number of folks don't have or want a corporation. So that is great. So if we move on, so demystifying corporate tax, certainly corporations are a separate legal entity. I know the lawyers have already had a previous session with this group, but from a corporation as a separate legal entity, it is created by statute. So that means some law has to give it life. And all of our provinces, territories, and even the federal government have a statute that will give a corporation existence. And so once it exists, it has a certain number of requirements and regulations. And one of the the benefits is a tax benefit. And so to answer the questions, do corporations pay less tax? The answer is usually. Certainly corporations pay a flat tax, which is different than people, which have a graduated rate of tax. People have graduated rates starting from 0% all the way up to 53%. Large corporations, it's a flat tax. You make $1, you pay 26 cents of tax in Ontario if you're a big business. If you're a small business, you earn $1, you pay 12.2 cents of tax. And so, depending on person versus corporate and where a person is on their graduated income scale, typically corporations, even a big business's corporate tax rate of 26.5% in Ontario is far less than an individual's 53.5% tax. And so do corporations pay less tax? Typically, yes. Because even if you're a small business, your tax rate is 12.2% in Ontario. And again, if person's graduated rates start at 0, the first federal bracket is 15. It doesn't take a lot to have a person who pays more tax than a corporation. And so that is actually true under the vast majority of circumstances. Corporations pay less income tax. So when do you incorporate? Typically, people incorporate for a variety of reasons, as articulated before. Legal liability is a popular one, and I think that's very true. Certainly, if I have my very biased income tax lens, you incorporate as soon as you have income. As soon as you have income, then you are paying income tax, and therefore the flat tax at a small business in Ontario is 12.2%. And so it doesn't take long for an individual who is earning business income to pay way more tax than that. So when to incorporate? Typically as soon as you have reliable profits. What kind of corporation gives the best tax advantage? I hear this question a lot, and the answer is there's really only one type of corporation in Canada. If you hear a lot of things about different kinds of corporations, S corps, C corps, LLCs, ULCs, that's typically American knowledge and American corporate statutes. Typically in Canada, we really only have corporations, and we may, and some provinces do have ULCs, or unlimited liability corporations. Fairly rare for people to go into unlimited liability corporations because sort of defeats the purpose of a limited liability, and that was what 60% of you wanted in your corporation. And so typically we only see one type of corporation in Canada. What type of corporation gives the best tax advantages? Again, there's only the one kind. There's no fanciness or magic about that. And so who should you have as a shareholder of your corporation? And we see this a lot. I get this question very frequently. And, it's simpler, it typically is better. However, there are material tax savings or benefits if there are a number of shareholders, yourself, your spouse, if your children are adults and you're okay with them being shareholders of your corporation, there could be benefits to having that diverse shareholder base. We can get to some of the benefits later on in the slides, but typically there's a balance between tax efficiency, legal liability, your other partners in your business, and also what your other founders or financing or lenders require. And so it's a kind of a balance of all these things, but this is an income tax session. And so certainly from my biased opinion, the more shareholders you have, likely leads to the best tax result. Sub question of that is, can you split income with your family? The answer is yes. There are a number of ways to do them. It is much harder than it used to be, but there are ways to split business income with your with your uh, with your spouse or your adult children. We wrote a whole article on that at EY at our Tax Matters, our November newsletter. So you can just look that up. It's free. It's online, and you can see some of those strategies there. All right, we'll move along to the next one. And so that's sort of the demystifying. So let's get some of the facts, the higher level facts in front of everyone here. And so corporations are separate taxable entities. So if you have a corporation, you file two tax returns, one for yourself, one for your corporation. And unlike people, corporations must file a tax return at least annually. Every individual, it's a may file a tax return. You must file if you owe tax, but if you have a refund on a personal tax level, it's a may file income tax. Corporations, profit, loss, inactive, dormant, it doesn't matter. You must file a tax return. And so that's often a cost of compliance that a lot of people who don't want corporations, they cite that. Like, I don't want a corporation. I don't want to have to pay an accountant to file this tax return. I don't want to pay a lawyer to maintain a corporation. There's a lot of cost involved. And that is true. And you balance off the costs with some of the benefits, the tax savings, the limited liability, the other things that corporations can benefit you in. So those are the trade-offs that everyone has to balance and make that choice. As mentioned before, corporations pay a flat tax rate federally and provincially. We're in, we're talking about Toronto, GTA, we're talking about Markham, but if your organization and you do business across Canada, what you actually do is you have a federal tax return and you take your profits and you allocate them to every province you do business in. And so a component of your income will be taxed by each province at their respective tax rate. So again, a fully blended big business based 100% in Ontario, tax rate's 26.5%. A small business based entirely in Ontario is 12.2%. Those blended rates are different across the country. But if you go to Quebec, top rate is 26 and a bit. If you go to BC, top rate is 26 and 26.7, I think. And the small business rate also varies coast to coast to coast. And so there could be some benefits to having a national presence in addition to growing your business, but also certain provinces have lower tax rates. The notorious one are out west with Saskatchewan, Alberta, and Manitoba. They actually have a lower corporate tax rate than even Ontario's 26.5% or 12.2. Things for corporations, they have to set a year end. And so people ask me all the time when they set up a corporation, well, what is my year end? Or your lawyer has asked you, what is your year end? You ask your accountant. And your year end can actually be any date you want. It doesn't have to be December 31st. People, our year end must be December 31st. A trust, their year end must be December 31st. Corporations can pick any day they want. It can even float. Your corporation can be defined by, the second Thursday in March. It's fine, like that's actually okay. But typically, from a practical basis, people pick a year end that lines up with a month end or a quarter end that falls right after their projected busy season if they are a seasonal business. Again, it's holiday season. A lot of retailers have December 31st, right? After the holiday season, Black Friday, Christmas, Boxing Day, those sorts of things. That's their year end because it's after their projected busy season. Other folks have different seasonality in their businesses. Other folks don't have seasonality at all. You can pick any day they want, and all are equal and opposite. More practical stance. I love folks with off-calendar year ends. It warms my heart. And so if you are looking to warm the heart of your accountant, pick something that is off calendar, because certainly they'll be able to deal with you at their less busy time, and certainly be less competition for resources at that point in time. Speaking of year ends, did see that question come in from Austin. You can change your year end, but you actually have to get permission first. Because once a year end is set, it is fixed. There are ways I can force a year end to change. But if you are carrying on and you think, oh, I've made a terrible, terrible mistake, or my business has changed, this year end isn't working for me, you can request from Canada Revenue and the ministry to change your year end. Typically, those requests are granted 100% of the time, but it does take a couple of weeks to submit the request and get the approval. And the request has to be done in advance of your year end. You cannot retroactively change a year end. Corporations also have to have a separate set of records. So again, like any organization, any good business, you have books and records, you have your QuickBooks, your accounting records, you have your sales registers, you have your HR records, you have your legal records. That separate set of records must be maintained. It is actually a legal requirement to keep a set of records for your corporation. And your corporation must also produce financial statements. So your QuickBooks or your Xero file may spit out financial statements for you, and that's great. If you have a different type of system, then you do have to create financial statements. The reason those things all align together, corporations must file a tax return annual, corporation must produce financial statement annually, corporation must keep a set of records, it's because those sorts of things actually go to Canada Revenue altogether. When you file a tax return for the corporation, you also submit a copy of the financial statements. Very different than individuals. When I send my tax return in, it's just a tax return, there's nothing else. Whereas a corporation sends a tax return in, it must include a digitized version of their financial statements. And so that's why all those things are important. And for those folks who don't want a corporation, the costs of compliance and maintenance of all those separate things are often a reason as to why people don't want corporations, and they can carry on their business outside of a corporate structure. So that's something to keep in mind as you are just seeing the corporate structure. Some benefits, if we can advance the slide to the next slide, there are some benefits to Canadian corporations. The first one I spoke about was corporate tax rates. Again, small business deduction gives you a corporate tax rate effectively about 12.2% in Ontario, and that rate is applicable for the first $500,000 of taxable income annually. So it's a very powerful benefit for many organizations who are starting up to have a much lower rate of corporate income tax that allows you to really reinvest and grow your business. As Cecile will speak about later, there are enhanced incentives or research and development credits that are out there for corporations. There are some benefits on a sale or exit or a secondary or an investment round. Folks may have heard about something called a lifetime capital gains exemption, where you sell shares of your corporation that is a business that's operating in Canada, and you meet a number of other criteria. At the moment, assuming legislation goes through, the first $1,250,000 of those sales proceeds will be tax-free for each separate shareholder. So again, going back to my initial thought, more shareholders are better in your family. And that's because this capital gains exemption can be multiplied. So if you and your spouse both have shares of the corporation, you sell the corporation, then the first $2.5 million of the sales proceeds are tax-free. Otherwise, there would likely be taxed at about 35% if you're a resident of Ontario. And another benefit that could exist for corporations is, let's say you start up your business, it grows, it's great. However, you're looking to transition and you're not actually looking to sell your business to an outside party or a strategic investor. You're actually looking to sell it to your employees or your management team. The employee ownership trust regime has recently been overhauled to allow people to transition their business to their employees through a trust structure. and that creates a number of tax benefits as well. If you participate in an employee ownership trust proposed, instead of a lifetime capital gains exemption of $1 million tax-free, an employee ownership trust rollover is about $10 million tax-free. So it's again, a significant and powerful vehicle that can be used um, for businesses who use a corporate structure. And the final one is a Canadian Entrepreneurs Incentive. This is a proposed incentive for founders of Canadian businesses, where in addition to the capital gains exemption, there's an additional tax break that can be gained if founder starts up their business, grows their business, and either has a secondary and sells a component or has a full exit. There's an additional tax incentive that they can yield at that point in time. So again, in addition to the lower corporate tax rate on a regular basis, enhanced refund or shred credits or R&D credits on a regular basis, there also are some benefits on a secondary or financing or on a sale of your business. Not everything's rosy. Costs. Not everything is sunshine and roses in Canada. So because we have a corporation and it's a separate legal entity and it's a separate taxable entity, people own corporations. So if you're telling me that corporations pay less tax, yes, they do. But when a corporation returns some of that money to its shareholders, the person pays tax too. So are you telling me I earn $1 in my business, I pay 12% tax, I pay some money out, then my person pays more tax? Wait a second, it's that same dollar, we've paid tax twice. The answer is sort of. Canada is an integrated country such that we get credits for tax that have been paid all the way through the system, so that overall you shouldn't pay a higher rate of tax than if you just earn the money personally. But based on certain legislations and certain policy objectives from the federal and provincial governments, they will allow you to have these tax benefits, these tax breaks, and tax deferrals. So there is an inherent double tax. We'll go over some math later to prove it and prove that it's not the end of the world, but it is something that can be done um, um, or managed, but it is a real cost and it is a real thing. And as I mentioned before a couple of times, cost of compliance. Again, a separate set of books and records, legal books, accounting books, tax filings, like there are costs that are involved in maintaining a corporate structure. So those are the benefits, costs, talked about a demystifying. Do you want to talk about some registrations and timelines and deadlines? So for the folks who already have a corporation, this should be old news. For the folks who don't have one yet and thinking about it, these are things that have to be done. So when you set up a corporation, Canada Revenue automatically finds out, especially if you register with Ontario. So if you open your corporation under an Ontario Business Corporations Act, corporation can have a name, can have a number, it doesn't matter. Canada Revenue finds out immediately and automatically issues a business number. So just like you or I have a social insurance number, 9 digits, 3, 3, and 3, corporations are issued a business number, 9 digits, 5 and 4. And so every corporation has one, just like every human has a social insurance number who's here in Canada and pays tax. So for sure you have to do the registration. You get the business number right away. And a corporate business number is sort of like the first piece of the puzzle, and that gets issued automatically. You'll get a letter in the mail when mail runs, but you'll get a letter. And in addition to that, there are suffixes, and every suffix corresponds to a type of tax. I know it's weird, but that's how we work here in Canada. So your basic corporate business number is 9 digits, and then there's a suffix. So for income tax, the suffix is RC, likely 0001. So your business number would be 12345 6789 RC 0001. And that's the full income tax number for a corporation. We'll see later there are other suffixes that you can attach to your business. And so you can continue to reuse the first 9 digits for each account and each type of tax the corporation has to deal with, but the suffix is coded to that specific account. So you have to open, so that the business number gets issued automatically, but the suffix account you have to open yourself. You can go into CRA My Business account and open it there, or there's a form you can fill out an RC1 and send it in, and they'll open your income tax suffix for you. Depending on what province you're operating in, you may have to register provincially. So if you operate in Alberta or Quebec, you actually have to register with them separately. If you operate in Ontario, it happens all together with Ontario and the federal government. Timelines and due dates. So as a corporation, let's say your year end is December 31st, even though I told you not to, but it's actually it's by far and away the most common. So December 31st year end, your taxes are owed to the government 2 or 3 months after year end. So either February 28th or 29th, as the case may be, or March 30th. And the 2 or 3 months depends if you're a big business or small business. Big business, the taxes are due February. Small businesses, the taxes are due in March. But the tax return itself, the actual filing and sending in of the tax return, is not due until 6 months after year end. So June in our example. So the government wants their money really fast, and you can file when you get around to it. It's typically the story in our line of work, in our business. Many of my clients do file within 2 or 3 months of year end because I've done all the work to calculate what their tax owing is. And so I might as well just file the tax return right away. If you, for most corporate income tax filers, again, based on your province of operations and jurisdiction, it can be done automatically or harmonized with your federal income tax return. But if you have operations or incorporated in Alberta or Quebec, there are physically separate tax returns you have to file with them. So everything can be electronically filed. There's actually a requirement to electronically file for corporations of a certain size and of a certain revenue and profit threshold. And so that's typically the default way of doing it. There are some low or free versions of filing corporate tax returns online, but most of them are a fee for service, or you can pay a bookkeeper and accountant to file for you. So I'll pause there for income tax questions about corporations and setting up, and then we'll move on to the next topic, which is sort of a subtopic of income tax, which is that double taxation problem that I alluded to earlier. I've got one question in the chat that I'll field now. If there's any more, send them in. And I don't see any hands, but I'll field the question. The question is, can an employee ownership trust be used with family members as a way of estate planning? At this moment, no. Hamid, I think, or I know that they're mutually exclusive. So if you sell to an employee ownership trust, it goes to the employees, and there's very little retained interest within the family. If you go the other way and it's going to be transitioned to the family with family trusts and other estate planning, that's great, but they are mutually exclusive. Yeah, why is it typical and best? So right after a busy season, from a practical standpoint, the year or your seasonality, you work up to a year and then you finish. And so in terms of forecasting, budgeting, cash flow, having your year end right after a busy season gives you the best chance, or what I've seen, it gives you the best chance of tabulating all of that data and not having a year end right in the middle of a busy season, but also not so far away from your projected busy season that your forecasts, your projections are totally out of whack and not useful. And then from that perspective, if it's right after, your people, from a human resource perspective, have the ability to close the books, talk to the accountant, get the files over, file your taxes, do your final payment, because your final payments still do pretty fast after your year end. And so you don't necessarily want all of that internal resources, or all those internal resources consumed by running your business, where you have these administrative important filing deadlines to take care of. Okay, good questions. All right, next question, Alina, polling question. So what type of compensation is the most tax efficient on a fully distributed basis? Salary, regular dividends, eligible dividends? I didn't put an option of I have no idea. I do want people to take a guess. If they do, you can chat GPT it, Google it very quickly, but this is more of a curiosity and demystifying, because again, we do have those built-in 2 layers of tax in Canada, but I want to talk about it and also show it's not so bad. right. Got about half of the folks answered. I think just another 10 seconds and then we'll keep on moving. All right. So fairly good, consistent with what I usually see. About a quarter of people are salary, a quarter of people are eligible dividends, half are regular dividends, which is good. I like to see a distribution. I like to see people throwing their vote somewhere. And the right answer, well, we'll see in a moment. And we'll see yeah. We'll wait with bated breath until when I show you the math. So, Lena, if you can advance the slide, just to talk about just the concept that we have. So, again, unlike the United States, unlike some countries in Europe, unlike some countries in South America, Canada's system is what's called an integrated system, which means Canada appreciates that there might be layers of ownership to any business, but as you pay tax at each subsequent layer, then you get credit for the tax that has already been paid. And there are ways to track that, and there are ways to give credit for that. The system's not perfect. In an integrated system of many integrated systems, none of them are perfect, but that's certainly Canada's system and what we work through. And so our basic premise of integration assumes individuals or people are at the top of the food chain because everything must be owned by a person at the end of the day. And so they sort of pivot, our policy choices and our math and our arithmetic pivots around an individual. And the principle is a dollar earned in any structure, any vehicle, any series of vehicles should actually have a similar overall tax rate when distributed. And it's the when distributed that's really important because some structures give you a benefit of a tax deferral, and which we'll go over in the math. Again, our integration is a system that attempts to minimize the instances of double taxation and really ensures that there's equality regardless of your ownership. And as mentioned, there are some arbitrages or deferrals. So let's get to the math. And so this is sort of the punchline. And if you were to, Google any sort of rate card or rate chart, even on EY, I put our link on the slide. You can look anytime, any year, any province, and just look up the rate. And the rates are all tuned on the personal tax column for a top rate taxpayer. And that's really important. And that will lead to actually some arbitrage opportunities that we'll talk about later on. But if you are a top rate taxpayer, the rate you pay is 53.5% on ordinary income or a salary. If you are not, the rates are different. As I mentioned before, people are graduated. Your tax rate as a person goes anywhere from 0 to 53.5, but on ordinary income. But if a person earns a dividend, so let's say they have a business, earns business income, pays small business tax rate, and pays a dividend to their shareholder, the top rate of tax that the individual pays 47.74 because there's credits involved. And then if you own, let's say, a big business, it will pay a top rate of tax at 26.5% and a personal tax load of 39.3. If you add across the rows, those should total to the number, those total, and I'll prove it, to the number on the far right. If you were to pull out your calculator and say 12.2 plus 47.74 does not equal 54.12, Amir, I know, and it's deliberate. Do not panic. Accountants can add mostly, and so it does work. And same thing for that last row, 26.5 plus 39 does not equal 55, but I'll show you how it works. So on to the next slide. And so here's an example of how it works. So if we take those 3 rows, and now I've turned them on their side to 3 columns. And the person earned personally is that column of, there's no business tax paid. Everything your business earns, you pay it out as salary or a bonus to yourself. So your business has no taxable income, pays no tax, but you do. You pay all the personal tax. Small business income means, your business, you've incorporated, it earns income, pays tax at a low rate of 12.2 if you're an Ontario corporation, and then pays out the rest to be taxed at an individual level. And then general income is the same before, but with big business rates. And so you'll see that at each time I'm starting with $10,000, Corporate level, same math as articulated before, 12.2 for a small business, 26.5 is a big business. It pays what's left to the shareholder, just to keep apples and apples and apples comparison. With that, there is a personal level of tax. And if you recall in the slide before, personal rate of tax on a small business dividend is 47, but I didn't have $10,000 to pay. I had $8,700 to pay tax at 47%, and that's the personal tax load. So you add up the two rows of corporate tax and personal tax, and you end up with the total tax load on $10,000. And lo and behold, the effective tax rates are in and around 53.5. Again, integration is not perfect, and it strives to be close. So actually the most efficient method of taxation is no corporation at all, or just paying everything straight out. And so for those 25% of folks who said salary is the most efficient way to tax earnings on an income tax basis, that is actually true. Everything else has a slight cost. Now, the one thing that you'll keep in mind is for that small business and regular income, there's a tax deferral built in there, right? Like if you take that $10,000 and you don't pay it all out to the shareholder, then that money can be recycled in your business and grown without another layer of taxation. So there's the big tax deferral in those structures, and that's a policy decision. Like our government deliberately allows that and encourages that. So that's there, that exists, and that's really our system of integration there. So then commentary. So this theoretical integration does exist, but it exists under, academic circumstances. There are some oddities. So where you have, again, everything is tuned around a top rate taxpayer. So where you have a person who's a shareholder who is not a top rate taxpayer and takes out a dividend or even a salary from their corporation, then there is actually a tax arbitrage. You actually win. You don't end up paying 53% tax or 54 or 55% tax all in. Because again, corporations are flat tax, people are graduated. And so there are actual arbitrage opportunities. And we've got UI calculators out there that you can sort of play with to see, oh yes, if my corporation earns this much money and I earn this much money, how much tax do I pay? And even more so for very low rate taxpayers. Again, back to my point of lots of shareholders are good. For folks who earn really low rates of income, let's say like 30 or 40 or $50,000, a dividend from a corporation could be tax-free or very low taxed, even if you have $30,000 of income. And that's because, again, our system is tuned for top rate taxpayers, and it's not very, and it doesn't have any accommodations or adjustments for any taxpayer that's not earning more than 250. It just, the arithmetic is the way it is. It works the way it does. And so that leads actually some arbitrage opportunities for taxpayers or shareholders who are under $250,000 of income on a personal level. I'll pause there because that's the end of income tax for corporations. So I've got a couple of questions that come in. Corporation actually doesn't save you tax costs. Yeah, all in, Mark. Like, all in. If you earn everything and distribute everything, and that's all you do with your corporation, and you don't use the corporation as it's designed to reinvest and grow and defer tax, then you're actually not doing the right. Well, you are actually paying more tax than you otherwise would if you just ran your business as a sole proprietorship out of your garage. And so that's one of those things that, it's really good that people have corporations for the reason of limit your legal liability. Because as an income tax person, I am narrowly and keenly focused on income tax and optimizing that. But I appreciate I operate in a very diverse and dynamic business world where you may make choices that have trade-offs. So you may have a corporation to limit your legal liability, knowing full well that there might be an overall tax cost to that strategy. Yep, rates, good. And yeah, these are 2024 rates. On the assumption, yeah, these are 2024 rates, no changes there. And everything we've talked about today assumes the budget proposals do get completed. So talking about employee ownership trusts and Canadian entrepreneurs incentives. Good. All right. I don't see any other questions or hands. So let's go to GST, HST. So yes, as an income tax person, I'm now masquerading as sales tax and payroll tax. Taxes, taxes, tax. I hear you. I hear that a lot. They are technically different, and I'm I mean, know enough to be dangerous. So have you registered for GST, HST is our first question. Just more for me as a knowledge check to determine how far in we go to these topics. And there's no follow-up question in terms of why, because unlike other things, the why is often determined for us. All right, Alina, maybe just another 10 seconds, and then we will keep on moving. Okay. So about 50-50 in terms of the result, in terms of have you registered. And it's a mixed bag, right? There are thresholds that require you to register for GST, HST. There are certain industries that require you to register for GST, HST. And there are also, as always, there's a hassle in compliance. Sometimes people will register deliberately for the benefits that it yields. So if you can advance the slide, we can start talking about GST, HST. So GST HST is a sales tax, so goods and it's a sales tax. And other jurisdictions, many European ones call it a value added tax or a VAT. And basically what it does is it's on consumption. So if if you're to spend $100 in Ontario on some widget, then you would pay as a final consumer 13% of that sales tax. So where you have purchased something from someone else, sales tax is typically triggered. So why does it matter? And sales tax and payroll tax are sort of together in these very serious taxes because the individual or corporation are delegated as an agent of the crown. You are now a tax collector. If you've registered for GST, HST, you are now a tax collector. Congratulations. I'll send you a star. And because you are a tax collector now, you work for the government and they watch and regulate GST, HST very jealously. And they do the same thing for payroll as well, because you are an agent. You are now a tax collector. And that's why it matters. And that's why it's important to get it right. Because unlike income tax, which again is very serious and very important, that is my day job, GST, HST is something is I would say the next level. For example, for corporations, you have boards. Your board members, are important for governance. If you have an unpaid income tax liability, that stays with the company. If you have an unpaid GST liability, they will come after your board and the board members' houses. Like that's how serious GST, HST, and payroll is. So that's why we're having the session here, and then just really important the seriousness of it and making sure that you do the due diligence, ask questions, and try to get it right. Because like all things, we try our best. As long as you're not malicious about it, CRA will cut you a break, but it is very important. Adding to how very important it is, there are so many different kinds of sales taxes in Canada. It's worse in other countries, but we do have GST, HST, PST, QST, RST, insurance premium tax, and other sales taxes that are out there. Most of them have separate filings and requirements. If you are an Ontario business that operates entirely in Ontario, and all of your customers are Ontario, all of your suppliers are in Ontario, then likely your only problem is HST. If you sell or have employees or have suppliers in other provinces or jurisdictions, then you may have, I don't say problems, you may have requirements in other provinces. Each province and each sales tax has their own requirements and filings. And so if you're starting to dabble outside of Ontario in a very relatively safe HST world, then it's good to ask for help or ask questions. The sales tax and ITC systems are important, or how they're supposed to work. Again, because it's a value added tax, sales tax is only supposed to be levied on the incremental value that you add to that product, or if you're the end consumer, you pay the full amount. So for example, if I buy an input to my widget and the input is $50 and I sell the widget to the next person in the supply chain for $100, then I've added value of $50, right? I bought it for 50, I did some process, I sell it for 100. The value I've added is $50. So on net, I owe the federal government, or I owe the blended federal government as an Ontario person, I owe the government 13% of $50, which is $6.50. So I charge $13 to the person who I sold the $100 widget to. I paid $6.50 to the person I bought the $50 input to. My difference is what I actually remit to the government in my tax collector role. And so that's how it's supposed to work. If I'm the final consumer and I buy the final widget to consume, use, whatever I do in my personal capacity, then I pay the full 13%, and that's the end of the story. I don't get any offset because I haven't added any value or resold the widget to someone else. That works with services that as well in terms of the similar principles, except the inputs are not really other hard tangible goods. They're usually softer goods. And so the delta of the value you add is typically much bigger in service or knowledge-based businesses. The concept in sales tax world is a taxable supply. So have you done a taxable supply? So if you ever talk with CRA or a CRA auditor with respect to GST, HST, they'll ask, what are your taxable supplies, or what is the total value of your taxable supplies? And that just means the things that you have sold or purchased that are subject to GST, HST. There's a difference between sales that are rated that with a number. So typically most of our sales are rated at 13% because that's a normal GST or HST rate in Ontario for most goods and services. There are items that are zero rated, so things that you sell for with 0% GST, HST. So think children's clothing, fresh fruits and vegetables at the grocery store. Those are zero rated. And things that are exempt supplies. So financial services, interest, education, those things are exempt supplies. You don't pay GST, HST on those. The difference between zero rated and exempt is this value added component. If you sell a zero rated good, while you add value, you actually still can get a credit for all the GST or HST you've paid to sell that good. If you sell exempt supplies or have exempt services, then you are stuck paying the GST, HST on all the inputs, but you also don't charge GST, HST on the things that you sell. So there's that subtle difference. And again, lots of different businesses with us today. So just wanted to go over that subtlety in case it impacts your business. Also, there's a sales tax on imports and exports. So again, if you ship products in, there's likely GST or HST that you have to self-assess on that because you can't necessarily, beat the system by buying foreign goods rather than buying domestic goods, which would typically have a GST, HST component. And then also if you have an online or digital service business, there are online or digital services taxes. Think like the Netflix tax that has been recently imposed on folks who have online or digital services. Moving on. So registrations, things that are due dates. So registrations, talking back, you now need to open an RT suffixed account. So then you have to go online, or even on that same RC1 form, you can open an income tax account and a GST, HST account at the same time. And same thing for the provincial registrations. Again, if you're in a PST, QST, or RST province, then you'll have to do a provincial registration as well. The rate you charge, again, if you're just in Ontario, you have Ontario suppliers, Ontario customers, 13% across the board. However, if you live in Ontario and you have a sales-based business and you are performing your work here, but your customer is in Alberta, charge 5%. Oh, and that's a place of supply, right? Like where does your supply get made? Is it made at the customer's location or at your location? And there are a whole bunch of rules to determine what those, where the place of supply are, which determines what rate of sales tax you charge. And the CRA website is great. It has guidance, quick reference charts, flow charts. It's very helpful. So I think that's super, again, that's probably the best way I can arm this group with as much knowledge as possible, is just go to the website, get the guidance there, because there are not an infinite number of combinations and permutations, but there are a lot. In terms of timelines and due dates, again, just like income tax, GST HST has a filing requirement. And each taxpayer, like when you sign up, they will assign you a reporting period. And it's not like a year end. It could be a year, but it could also be as short as a month. And again, because you are a tax collector, the bigger your business is, the faster and more frequently Canada Revenue wants you to file and remit those taxes. So, an organization that's relatively small might have a year, which is their reporting period. And so maybe their fiscal period for income tax purposes is the same as their reporting period for GST HST purposes. Great. But be aware that it could be annually, quarterly, monthly. Like it actually can get shorter. So don't miss those requirements. And Canada Revenue is really good at letting you know of, hey, by the way, you were an annual filer last year. We're upgrading you to congratulations, your business is growing, but now you are a quarterly filer for GST HST purposes. So just keep that in mind, and diarize those due dates on your calendar, because they're very important. As soon as your reporting period ends, you have 1 month to file. So if your reporting period is November 30th, then you have till December 31st to file your GST HST return. CRA website also has some really good guidance and quick reference charts. So you just go to their website. It says I'm an annual filer with a December 31st reporting period. It will tell you when it's due, and also when your net tax is also due to be remitted. Last thing for sales tax, the other side. So again, charging GST, you're collecting it from your customers. You're also paying GST, HST on all of your inputs to your supplies. And those inputs are called investment tax credits, not to be confused with Cecile's investment tax credits that she'll talk about later. These are GST, HST credits, or ITCs. And typically on the GST you pay, again, it's a value added tax. That's our system. And so you get all the GST, HST that you've collected from your customers, all the GST, HST that you've paid on your inputs, net the two, and the net either goes to Canada Revenue, or if it's a net in a refund, Canada Revenue will write you a check. And so on the sales, on the GST, HST that you pay on all of your inputs, keep good records. Typically, if your business is starting up, you have more costs than sales, and so you'll be in that refund position. So it's really important to file and keep good records, because that's money in the bank. And then if you have blended taxable supplies, let's say your business has some taxable supplies and some exempt supplies, then so think banks, educational institutions, coaches, people who have executive coaches, those sorts of folks, they have a blend of supplies. Then you can track, okay, here are the costs that relate to my taxable business. Here are the costs that relate to my exempt business, and you can get investment tax credits on the taxable side of your business. If it's not obvious how it's allocated, you can do a reasonable allocation for your blended ITC rate. And unfortunately, as always, GST, HST is a federal legislation. If you're in a harmonized province like Ontario, the federal government's rules apply to Ontario. If you do business in another province, either have customers or suppliers, there actually are some subtleties between provinces. So this is one of those things that you have to just be aware of where you're operating and if there are any subtleties that impact your business. Okay. Pause there really quick for GST, HST. I'll see if there's anything that we can field here. Yeah, digital service. Yes, digital service tax, talked about that, links to that. Mark's doing great. Sorry, guys. Sales tax for SaaS, typically, yes, based on the customer's address. Again, if you do all your products or your people and all your production is in Ontario versus where they are, typically the place of supply rules will say the place of supply happens there at their area. Talked about the thresholds. Yes, 20 million. It is a big threshold. You'll get there. I'm with you there, Austin. You'll get there. Good. Payroll. Let's jump to that really quick. So payroll, paying people, employees. If you've ever gotten a T4, if you've ever given a T4, that's payroll, that's employee stuff. And it's important, as I mentioned before, with GST, HST, you are now a tax collector. You are an agent of the government, and they take it very, very seriously. And so payroll is the process of tabulating, identifying employees, making sure they're paid on a regular basis, pursuant to employer standards in your province, but also remitting the correct amount of income tax, CPP, EI, and other provincial taxes to the relevant governments. People ask me all the time, can I just get out of payroll and all of that administrative hassle by just having independent contractors everywhere? And the answer is no. The government, again, guards their sales tax and their tax collectors and their roles and responsibilities very jealously. They want you to be tax collectors. They want people to be employees. There are some legitimate arrangements that are contractors, and so you pay them, there's a contract, they send you an invoice, you pay them, and that's the end of it. But if it looks like an employee and acts like an employee and has the same responsibilities as an employee and they work the same as an employee, they're an employee, regardless of how you internally classify them. And there are significant penalties if Canada Revenue comes in and determines that all these people whom you've classified as contractors and not done the required withholdings, there are significant penalties for the company to get compliant. So for payroll, yet again, another account suffix. So again, the same 9 digits for your business number carries over, but you have to open an RP account. So the P is for payroll, the T is for GST, and the C is for corporate income tax. And so most businesses actually have one business number, 3 accounts: income tax, sales tax, and payroll. Those are the most 3 common for most operating businesses. For legal purposes, understand the employment standards in your province, and also the employment standards of the provinces where your people are working from, especially if you're in a remote work environment. Be aware that there could be implications if you're in Ontario, but you're hiring someone from BC. A lot of discussion, certainly from my employment lawyer friends, of like, well, what laws govern? Is it Ontario, the jurisdiction of the employer, or is it BC, the jurisdiction of the employee? So just be aware, ask the right questions. Timelines and due dates. So every time you pay someone, there's remittances. If their salary is $100, then they don't get $100, right? There's all these withholdings and deductions and all this stuff from your paycheck. And so let's say you pay them on November 30th, then those remittances that you've withheld are due to Canada Revenue typically December 15th, so 15th of the month following payment. So at very least you get 2 weeks ish. At most you get a month and 2 weeks or 6 weeks to do the remittances, but typically they happen very fast. Again, you're a tax collector. And so if you contrast income tax, which gave you 2 to 3 months to pay, GST, HST gives you 1 month to pay because you're a tax collector. Payroll gives you about at least 15 days, at most 45. So again, the more tax collector your role is, the faster the government wants their money. And then you have an annual reporting for your T4s in February. T4s are done on a calendar basis, regardless of your fiscal period, reporting period. Payroll things are done on a calendar basis. And most of those reports must be e-filed. There are some exemptions if you have a few employees. I can't remember what the threshold cutoff is. It used to be a number and they keep on dropping it. So I'm not exactly sure what that threshold is. But most payroll things must be e-filed. The things that you'll have to be worried about in terms of payroll. So there are federal withholding taxes. So you get federal income tax, CPP-EI. There are CRA calculators. They're super helpful, and they're actually quite good. Like you type in the person, their pay frequency, how much they earn. It'll tell you exactly how much income tax, CPP, and EI you have to withhold and remit. Keep in mind that CPP and EI, if you have to withhold $1 of CPP for an employee, there's a a matching component. So the company that has the employee also has to chip in an amount. So in addition to withholding from the employee, there's also a cost of business to complying with the payroll regime. And so that's something that people have to keep in mind. And when you run the calculator, it'll say, oh yes, withhold $20 from your employee, but remit 30 to Canada Revenue. And you say, well, hold on, wait a second here. I held back 20 from the employee. Where did this extra $10 come from? Well, there's this matching component that you'll have to do. And again, the calculator breaks it out for you really well. Keep your records because they're very important. There are provincial withholding tax as well as income tax. There's workers' comp, employer health tax based on your province and various thresholds there. So again, just take a look, do some research and find out which ones are applicable to you and what their effective rates are and how you file and register. And then there are some local or contractual payments. So again, if there's a union or pension matching, earnout, severance things, those things are also payroll related, and just be aware of what those are. And finally, benefits. As an employer, it's your responsibility to determine if a benefit, in addition to their salary, is taxable or not. Right? Like many people have said, oh, I've got a taxable benefit from my employer, or I get a company car, or I get to use the company, cottage, or whatever it is. That could be a taxable benefit. And if that's the case, it's the employer's responsibility to A, identify that's a taxable benefit, B, quantify it, and C, put it on the T4 for their employees. So again, that's all part of the whole payroll kit and caboodle. And finally, the record keeping. Again, accurate records for each employee are important, and issuing pay stubs on a regular basis, at least annually. So yeah, so that's everything from payroll. I saw things happening through questions, but after this, it'll be Cecile talking about incentives. So I'm all doom and gloom, right? Like these are all the taxes you pay, all this and that, the payroll, GST, they're going to take your house. Certainly, certainly the next section is a bit more positive in how the government's looking to give you money. All right. Their gig economy. Yeah, so gig like Uber, those are typically contract employees, or even a lot of Amazon drivers are contract employees. So from a reporting perspective, they're just like your bookkeeper, your accountant, or your lawyer. They send you an invoice, you pay them to carry on with their day. Yeah, employment standard stuff with employing minors. Let your lawyer square up with that. Yeah. Okay, I think I'll look at the rest and probably field them later in our question and answer period, but I'll let Cecile go.
Thanks, Amir. That was awesome.
Thanks.
So I have some very simple questions to start off with. Nothing about salaries or dividends, but I'm covering incentives in general, but I'm just curious who in the group has heard of the Scientific Research and Experimental Development Program, or SHRED, as we like to call it. Okay, we're at about 40%, and it's just jumped to a 60-40 split, which is nice. Okay. So we're sitting at about a 65 have heard of it and 35 have not, which is great. So we have a mix. I know that Alina said that you guys had a session on SHRED once before, but we're going a little bit more in depth today than maybe you heard about in the last session. So I just have one more polling question after this one, which is for those of you who have heard of SHRED, who has filed a SHRED claim? Okay, we're sitting like overwhelmingly no, and there's a couple of yeses. Yeah, so 92% no and 8% yes. So this is great. So go ahead and you can go ahead and switch the slide, Lena, if you like. So I'm going to be talking about incentives in general, but a big part of what I do with my team is incentives in general, but a big part of those incentives is SHRED. So I'm going to start off by speaking about incentives, SHRED for most of it, and then a little bit of the discretionary incentives that might be interesting to this group. I'm definitely not covering all of them that are out there. There's a lot, but they're sometimes very specific to the type of business you're pursuing or what type of funding you're looking for, your corporate structure. So we'll touch on some of them, and hopefully you walk away today with some new knowledge for some funding that's available. So incentives typically fall into these four categories. So there's business and market expansion, environmental sustainability, innovation development, and people development. So business and marketing, if you're doing a facility expansion, you're transforming a process, digitization, expanding to foreign markets. Environmental sustainability is more along the decarbonization route. So you may have heard, all the buzz right now in our service line is about these clean economy ITCs that relate to decarbonization. Then innovation development, which is where the SHRED ITCs sit for research and development. If you collaborate with universities to do research, and to some extent transformation and digitization as well, if it involves an element of uncertainty. And people development, so job creation, hiring, training. So if you're looking to hire some students to do some work for you, you can get some grants to help offset the cost of bringing those students on. So I'm going to launch, if you want to switch the slide, Alina, I'm just going to launch here right into SHRED. So like I said, it's going to go a little bit more in depth than maybe a previous session that you've had, but I think that's a good thing. So if you just want to, great. So what is SHRED? So SHRED is actually a program that's been around for a long time. It's administered by CRA, and there's also in certain provinces like Alberta and Quebec, which seems consistent with sales tax and tax return filings, who have their own programs where you have to file separately, and sometimes they will look at your claim separately as well. But they distribute about $3 to $5 billion a year in investment tax credits. And I think the biggest difference between SHRED and some of the other incentives I'll be speaking about is that SHRED is not a grant. So SHRED is really based on if you are doing eligible work. So I think I cover this later on another slide as well, but if you are doing eligible work, you are entitled to these ITCs. It's not like you're applying to a pool of funds and only the best 10 applicants get some of the money. It's really based on eligible work. And the claimants can recover 15 to 48% of your expenditure. So that really depends on, are you a large, non-Canadian owned private corporation, or are you a Canadian owned private corporation, and varies in which province you're doing the eligible work. Go ahead, Alina, to the next slide. So I apologize, it's a little small, but this kind of illustrates across Canada how much of an ITC can be earned. The yellow shows Canadian-owned private corporations, and the gray shows, shows large corporations and Canadian-owned private corporations with taxable capital of over 40 million. So taxable capital is a concept I'm not going to cover today, but typically if you're a large corp, your taxable capital is often over 40 million. But it just kind of shows you the distribution. Every major province has their own program, and they're pretty much the same. The biggest difference in Manitoba is that you can still claim capital, which means you can actually claim assets that you purchase as long as they're used solely for SR&ED purposes. But every other province does not allow capital expenditures anymore. So this is just a nice visual, but we won't spend more time on it. So some unique program features, I already covered some of these. So you can claim retroactively. In fact, you kind of have to claim retroactively. It's kind of like a tax return. You are filing with your tax return, which means you are filing after your year end has passed, but you have to file within 18 months of year end. If you miss that 18 months after year end deadline, you cannot go back and file a SHRED claim for that period. It's broadly applicable, which just means that it doesn't matter what industry you're in or what you're pursuing, as long as you're doing eligible work, which we'll cover later as well, what eligible work is, you are entitled to claim the credit. It respects competition, so that's really just in regards to keeping, all your trade secrets of this new technology that you're developing confidential. And that's the same with confidentiality preserved. Failure is acceptable. So this one's always funny because I always tell my clients, usually you go into meetings and you are saying how great everything is going. SHRED is the one thing where you want to talk about the failures and you want to talk about what went wrong. and how much it cost you to fix those errors, or how much it cost you to go down the wrong route. And that's why we often end up talking about the failures rather than the successes. Uncapped benefits, so it's available to all companies and industries in Canada as long as you're operating in an eligible field. Not a grant, I covered that earlier as well. And it's a mature program, so just again mentioning that it's been around for a long time. I know that some of you may have some experience with other grant programs where there's a really short intake period, or they've kind of maxed out their funding, or whatever the case may be. Shred's been around for a really long time, and in the budget they actually announced they're going to be increasing the funding for Shred, which is great news. So it's not going anywhere. Alina, go ahead. Just one more. So I'm just going to talk about the technical side of the Shred claim. So my team is made up of accountants like myself, and also technical specialists. So we have everything from PhDs in chemistry to mechanical engineers, oil and gas engineers, and we kind of team up to write up the technical description, which is what's the technical work that's eligible. And then the accountant on the file would do all the costing, so gathering all the costs that are eligible, and I'll go into the eligible cost categories as well. But basically, there's there's two things that we focus on in the technical section, which is how. So a systematic investigation or search that's carried out in a field of science or technology by means of experiment and analysis, and why. So there really has to be a purpose of advancing the knowledge that's out there already. And Alina, you can switch down because I think the next slide or the one after that illustrates this nicely. Okay, well this one's just honing on the how. So you're attempting to overcome an uncertainty that exists. You're formulating a hypothesis just like you would have done almost in a high school science class report. It's a little more complex than that, but you're essentially following those steps. You're conducting experiments to test that hypothesis. And then you're analyzing data that's coming out of those experiments to figure out, did we overcome this technological uncertainty, or did we learn something? And then also maintaining the documents that relate to that data analysis and the testing and the experiments. Shred is big on documentation. So, that's probably the biggest challenge for our clients is they're trying to start a business. They have a million things going on. And often they don't keep the documentation that they might need to be successful in a Shred filing. You can still file, but if CRA reviews it, oftentimes they will ask for documentation or give you a recommendation to improve your documentation practices. But we know it's tough, right? When you're at 110%, you can't quite have the time to carve out some of that documentation. So next slide. So yeah, this is the one that I wanted to point out. So you as the claimant on the left here have a certain level of proprietary knowledge. And then there's, a certain amount of publicly available knowledge. So if you type into Google or ChatGPT, how do I solve this problem? And an answer is returned, and that you try that answer and that answer works. That is not eligible Shred work because an answer exists. You have not encountered a technological uncertainty. But once you cross that line and you're creating new incremental knowledge, that is when the Shred kind of begins. And that's when we start looking at the costs of what would be eligible. Go ahead, Alina. Okay, so I mentioned documentation, so I have a whole slide dedicated to it because it is really important. So in an ideal world, if you know or you suspect that you're doing Shred eligible work, you would keep extensive documentation. And I know, this is literally ideal. So if you don't have all of this, that's fine. But this is in a perfect world what CRA would love to see. So project planning documents, basically outlining that high school lab report that I mentioned. What are you trying to solve? What are you going to do to solve it? How are you going to analyze the data? Records of resources allocated to the projects. So ideally, you would have timesheets for all the people involved on your team that are working on this and what they did. Honestly, ideally on a daily basis, but even on a monthly basis or quarterly basis is okay. Something that you can present to CRA to say, this is what these people did, and that's why I'm including these dollars. The design of experiments, so how you're going about testing, project records, laboratory notebooks, we see that a lot for our clients. They keep those anyway. So it's a great way to support the work that was done. records of trial runs, progress reports, even meeting minutes. Like sometimes you'll sit, with your, depending on how many people are in your company, but sometimes the close counterpart that's working with you on that project, and you're just talking about next steps in the project, and keeping good documentation of those meetings is great. Test protocols, test data, analysis of test results, photographs and videos are awesome. CRA loves to see those. And contracts and invoices are key to supporting the costs that we want to claim. Go ahead, Elena. Okay, so eligible cost categories. So these are the types of costs that are eligible. So the first category, which is the category we see the most, is T4 salaried employees. So T4 salary employees means they're Canadian employees. They can't be outside Canada. Specified and non-specified just means if you hold more than 10% of the shares of your company, you are a specified employee, and therefore the amount you're paying yourself is treated a little bit differently when we calculate the eligible expenditures. Now, materials are items that are either consumed or destroyed while you're doing the eligible shred work. So the difference between those two things, materials consumed is if you purchase a material to use in your testing, and it's either destroyed or useless or valueless after that testing, and therefore is consumed. Transformed is if you're building a widget or a prototype, and at year end, that prototype is still viable, like you're still planning on using it for testing. Maybe you'll even sell it at some point later, but you're not sure. That would be considered, everything that's going into that prototype would be considered materials transformed. So contracts and third-party payments are essentially, oh, sorry, I'm slow, Alina, I'm still on this slide. Contractors and third-party payments are if you have a certain element of work that you need done, but you do not have the expertise in-house to do that work. So you have to hire a contractor to do that work for you. These expenditures are claimable at a little bit less than the other categories. You can only claim 80% of this. But that's if you bring someone in that's going to do that work for you. And then overhead. So overhead is essentially to compensate you for the cost of everything you do, a typical overhead expenditure, like the electricity in your building, or what it costs you to use your phone line, or very typical overhead expenditures. And there's two methods of claiming overhead. One is proxy, which is very simple. They just give you a flat 55% of your labor costs. And one is traditional, which means that you can literally claim every single line of overhead item that you feel is proportionately eligible. We typically encourage our claimants, if they have a large, labor component, to pursue the proxy route, because it usually ends up in a bigger claim, and it's less scrutinizable, if that's a word, by CRA. With a traditional claim, you can imagine they can pick apart every line item that you're putting in there, whereas proxy is just a, flat 55%. Okay, now I'm ready for the next slide. Support work categories, these are essentially categories for labor that are eligible. So these are the most common ones we see. Engineering, design, operations research, mathematical analysis, computer programming, data collection, testing, and psychological research. So if your T4 Canadian employees are doing this type of work and it relates to a technological uncertainty, then these are typically eligible types of work that we can claim. Okay, so that was the end of the shred section, and I see there's a lot of questions, but I'll get to those. Actually, I guess I can take a look if they're shred specific right now, and then I'll jump into the discretionary. Okay, so do we need an invoice for every transaction? It's ideal. To claim shred expenditures, they do have to, they have to be incurred by the business and show up on your income statement, or if you're capitalizing them on your balance sheet. And if CRA reviews your claim, they will ask for some sample invoices. They probably won't ask you for everything, but they will sample some of the expenditures you're claiming. A web app platform would qualify. It depends. It depends. Those ones are tough. I'm not an expert in that space, but I know that we have a lot of clients who come to us and they're saying we're developing this, but it really just depends on the type of development you're doing to build that app or platform. You said, I just did a shred assessment. It looks like it would. The next step is I can set up an appointment with a shred specialist to confirm eligibility. Yeah. So CRA actually has some great programs that are free, where you can ask them for their opinion. We're also happy to give you an opinion on it if you like. But yes, you're right, Austin. There's that service available from CRA. Can you claim shred for work you perform as a subcontractor for another entity? Okay, that's a great question. So when another entity hires you, you typically will sign a contract with them. And in that contract, it will stipulate a few things. First of all, who owns the IP? The second one is who holds the risk. So if you fail to perform on that contract, does the party that's contracting you still pay you, or do you hold the risk for not satisfying the terms of that contract? And there's a couple other, I guess, less important factors that factor in when CRA looks at whose shred is it, and those are probably the two biggest ones. So if you feel that you're entitled to the IP of that work, which honestly is rare, we usually see that the party contracting the subcontractor will write explicitly into their contract that anything you do for them while you're contracting for them is theirs. But you could consider, asking whoever you're contracting for if you can maintain the rights to the IP, and if you can claim the shred costs. It's definitely something that can be worked into contract negotiations. I'm not sure about Yvette's question. I'll leave that one for later. Yeah, Copilot.
Cecile, if you can take Christine's question, how do you prove something is research and not data gathering?
Yeah, so traditional science or tech, such as housing design for shred. What defines incremental knowledge? I think it goes back to that concept, Christine, that I covered earlier. If the data is readily available to what you're trying to solve, then that is not considered shred. But if you have to do experimentation, analysis, data collection is part of that, to gain the knowledge to solve that problem, then that's a good indication of shred. Other good indicators are, you're entitled to file a patent on something because of what you've developed. It's honestly, I almost think of it as if you're unable to find the answer for what you're trying to do in an online search, or now that we have, large language models like ChatGPT, then there's a good chance that there's an element of shred there. I hope that helps answer your question. Are IP costs related costs include shred? No, so unfortunately not. IP is one of those things that should be, but it's out. And I think patents is the same. I don't know at what stage you can apply for a patent. I'll leave that question potentially for maybe a lawyer at some point. But okay, if we want to go to the discretionary incentive slide. Okay, so these incentives are more along the grant vein, if you want to think of it that way. So where shred is kind of an unlimited, to a certain extent, pool. If you're doing eligible work, you'll get it. These discretionary grants are more so programs where there is a finite pool and there's certain characteristics that you're hoping to hit to get that funding. So this is just a slide that our team uses for businesses that are just starting, where this isn't something that everyone wants to maintain, but if you maintain these characteristics, you're likely to qualify for more of this discretionary funding. So one is remain a CCPC. So, imagine that someone wants to buy you out. Yes, you'll get less grants, but maybe it's a great deal to get bought out. So there's, pros and cons. SMEs with fewer than 500 employees, Canadian IP, so you're retaining the IP in Canada. Indigenous or Black communities, there's specific grants for those entrepreneurs in those communities. Women-owned businesses. Innovation is the key for a lot of these grants. Location, so depending on which province you're in, and connectivity with government, just staying on top of, and that's really the theme of this, the rest of the staying on top of what else there is out there for government grants, because it seems to be, there's always new grants popping up. So just staying on top of the search. And I've actually included a link here to canada.ca where you can kind of type in the characteristics of your business and what type of funding you're looking for, and it will return, it's a high level search, but it will return a search of some that you might be eligible for, and then you can go from there and research the types of things you would have to do. Now, EY offers those services as well, but this is a great place to start to see if some of the characteristics of your business would put you into a qualifying program. Yeah. Okay. So here, I just wanted to cover some specific programs. Like I said, I'm not going to touch on them all because there's quite a few. But IRAP is one we see very often. So it's intended for R&D, so intended to accelerate research and development of projects in Canada. But it's a great program in the sense that it covers a lot of costs. So often we'll see 80% of employee costs covered and 60% or 50% sometimes of contractor costs covered. It is a fairly, I think, intensive application process, but so worth it, right? If you can get that kind of coverage for some of your largest costs. Supply chain and logistics excellence, Scale AI. So we have a client that's developing a logistics software, and this is something that they're pursuing. So typically for existing supply chain practices, again, up to 50% of eligible project costs, which is very generous, right? You can get 50% of your project costs covered. No minimum or maximum investment, and a consortium of 2+ members is required. So that just means that you have to partner typically with someone in industry that will, I think, use your software or whatever the development is to get this funding. So I'm just covering the highlighted ones. So if you want to go to the next one. Oh, I think I want to cover both of these, but I didn't highlight them. MyTax. So this program is a program where you partner with someone that's typically in academia, so a master's, PhD, that's doing research, and you're paying for part of their, I guess, salary, if you want to think of it that way. And MyTax will also pay for part of their salary. So it kind of cuts down the cost of having some of these people do this work for you. See that one often as well. And then NRC IRAP Youth Employment Program. This is just specific to youth employment, but again, fairly generous. So typical assistance is $30,000 per placement, so per individual. So again, like a nice option if any of you are thinking about bringing on a student to help out with some stuff. And I think there might be 2 more slides. Yeah. So Southern Ontario FedDev, I know that's where most of you are probably located, helps companies adopt, adapt, develop, and commercialize innovative technologies that have a significant impact on productivity. Again, 50%, up to 50% of eligible costs and contributions can range from $125,000 to $10 million. Interest-free and unconditionally repayable. So it's a loan, but it has very generous repayment terms. It can really help boost your business, right from the get-go. Futurepreneur Canada, so financing support for entrepreneurs that are 18 to 39. Again, just helping you boost your business. I think there's some specific programs under that one for Black entrepreneurs and Indigenous entrepreneurs. Up to $75,000 again of financing and a very generous repayment period. And finally, I think this is my last one, but finally, IRAP IP Assist. So, IP awareness. So this is a great one for the individual that asked about IP and if it's claimable. This is a grant that will help you pay for the costs surrounding IP. So again, up to 75% subsidy worth up to $30,000, which goes a long way. And as far as I'm aware, it's the only program that covers IP. So that's great. And can export is one I wanted to touch on before Amir's last section here. And I think, Alina, you mentioned that the speaker tomorrow is going to be talking about this as well. But can export is a grant that helps you expand internationally and helps you with those marketing development activities. So we had a client apply for this, and it actually, you can use it for a lot of different things, including travel and marketing costs when you're trying to develop that international market. So that's a great grant if that's something you're hoping to expand to. Sorry, you can go ahead and go to the next slide. Pretty sure this is where I pass it back off to Amir.
Okay. Fantastic. Thank you so much, Cecilia. I'll start on the US structuring. I've only got a couple of slides, and while I'm doing that, you can scroll through the chat and pick your questions to field for our question and answer period. So certainly don't want to step on the toes of the next presenter, but wanted to talk about just outbound or US or any international structuring just from a tax efficiency standpoint. And there are three sort of basic stepping stones. And one is you have your corporation in Canada. You can operate a corporation in multiple jurisdictions. Like that's actually okay. Many organizations start this way because it's cheaper. You don't have to set up a separate subsidiary. You don't have to do anything. You just start selling into the United States or selling into Europe. You just do it. And what that means is you may have tax filings in both countries because you are carrying on business and generating economic activity in each country, and each country wants you to pay tax there. So there are pros and cons, and we'll talk about that on the next slide. The next one is a subsidiary. And usually, again, these are stepping stones. And so once people start to get some scale or actually having employees in other countries, they may incorporate a separate subsidiary in that country to house their salespeople, their payroll, fence off some legal liability, a number of considerations. And then finally, you can have an international structure where you have multi-tiered organization or corporations, structures, trusts, partnerships, all sorts of different things throughout your global chain. There are, say, more or less efficient ways to structure an international group, but again, these are sort of stepping stones, and really wanted to articulate that there's no obvious size or complexity where one business moves from one column to the next, but it is typically a scale, and every organization follows that scale for themselves. On the next slide, just some things to keep in mind as you're, you know, looking at your own organization and planning for its future journey in terms of international structuring. First of all, make sure it makes sense. Like, don't expand to Europe or the United States, South America, or Asia just because it's the cool thing to do. Really make sure it makes sense for your business, because there are, all the things we've talked about so far from income tax, sales tax, payroll, incentives, you know, that's Canada. And if I were to think globally, Canada's a fairly straightforward country. You go into other countries, you have all of those things, likely more. And so really the compliance, the amount of information, the amount of risk you take on gets amplified. So really make sure it makes good commercial sense to, step your toe outside of Ontario or Canada, and it makes sense. Typically the case is it's worth it because the markets are great, the opportunities are great, but just make sure it makes sense from a commercial standpoint first. As mentioned before, there's legal compliance in foreign jurisdictions. Again, their employment standards, their sales tax, their corporate structures, their corporate statutes are likely different. And so just understanding what you're getting yourself into. And some vendor customer relations, making sure your vendors know who they're dealing with, but sometimes they have a preference, right? Certainly a lot of my clients, when they do business in the United States with United States organizations, they like to do business with other US organizations. And so having a branch or a Canadian address or Canadian corporation be a party or the sales contracting agent is less savory. And so they set up a US subsidiary to handle their contracting. Talent, again, the source or location of top talent, sometimes it's not as easy to, uproot talent, and so you have to be flexible. And if they're an employee and they're acting like an employee and they work for you out of New York, well, then you likely have to do payroll in New York, and so you have to make sure that you have the structure and infrastructure available to facilitate US and New York payroll. And then tax, as I mentioned before, it is just different. So just understanding, or at least ask the right questions to at least identify what the opportunities and risks are. Onto our last slide, just things to keep in mind. Again, I'm all doom and gloom. I'm so sorry. Cecile's the fun one with all the incentives, but these are the things or the risks that people should keep in mind as they start considering their international journey. Again, do you have contract sales or operations? Do you create a taxable presence for yourself or like personally, or do you create a taxable presence for your business in other countries that require registrations and filings? When you sell across borders, even if it's a Mirco in Canada and a Mirco in the United States, they will buy and sell resources, products, services from each other. What is the price you pay when you're selling to yourself? And that is a thing. There's a whole study of income tax or taxation called transfer pricing. And we have a whole group of that at EY, and that's what they do. When you sell to yourself, what do you charge? There's income tax. There's some compliance exposures. Again, lots of filings to do. Payroll tax and sales and uses we've already articulated before. So these are just the things to keep in mind when you're expanding. Again, typically the market potential is great. Typically the rewards are great as well, just making sure that you have a feel for what the risks are when you take the plunge. And that is it. So I know we fielded a number of questions as we've gone through. I've gone back and picked a couple that I want to field. Cecile, suspect you've done the same, but I'll field the ones in the chat first. If others have some, they can come off mute, I think, or Alina, you can figure out how that works. But there's one or two in the GST or HST sections that I just want to field now. So the one was from MA. In simple terms, if I spend $1,000 on product and make $1,000 in sales, how does GST get work? Well, it's a value. It's the way I think it's a value-added tax. So you've added no value. So in essence, if you've purchased $1,000 worth of stuff, you've paid $130. So that's an ITC of $130. You've sold $1,000. So you've collected, presumably, $130 from your customers. $130 of sales of tax collected, $130 of ITCs. You file your tax return with a net zero owing to the Canada Revenue or back. So the principle of the value added tax holds true in that circumstance. That was the one I wanted to field. The other one is if you sell goods, sell something to a charity or a not-for-profit. Again, there are subtleties in the two of them, but you do charge, like you have to charge GST, HST like your business must. On the other side, though, a charity gets some of that HST back because most charities have exempt supplies. So think educations, hospitals, think religious organizations, they have exempt supplies. And so there's a specific rebate available for those organizations, but that's sort of the way it works for them. And then and the last one I have is hiring freelancers or just having any kind of contractor. Again, just be aware of the contract, be aware of, is this true independent contractor or are the types of things, the frequency of use, the hours that you're using them, the quantum that you're paying them starts to encroach as to something you would do as an employee. And that would just be the risk. Otherwise, it's just like any other contractor or supplier you have, they send you an invoice, presumably they charge GST or HST, you pay it and you carry on with your way. Cecile, back to you.
Yeah, I think the only one that I missed was from Layla. Customer discovery research for product services included in psychological research. Honestly, psychological research is one of the categories we don't see very often, but how I understand it is it would be research related to, human behavior or a thought process that a human would go through in a certain situation or in reaction to certain circumstance. So if you say customer discovery research, I guess it depends. I'm not quite sure what that would all entail, but there might be elements that are eligible. Is there any other ones that I missed that someone wants to ask?
Yes. I have another question at the beginning about WagePoint, for example, or similar app. Is recommended to have this account. For example, if I activate this account this month, how about the previous pay stub? How many months before activated account should it accept? For example, for the last 6 months or from the beginning of the January 2024, I want to. Previously, I provided Excel sheet and paid hourly to myself, my research. But this month, I opened an account for example, WagePoint. Now, I don't know what to do for the previous month and how I heard 6 months before is eligible. I appreciate if you share the updated, is that correct or not?
Yeah, Leila, I can field that one. And unfortunately, the answer is not going to be great. And that is, we should take this one offline. It sounds like a very specific question for you. And so I think we can field that one offline. And certainly from my perspective, and Cecile, I don't know about you, but certainly I don't know about WagePoint, but so I don't know about, the validity or appropriateness of that specific software, but certainly we can chat offline.
And
I
thank
did,
you. And do you share with us your contact email?
yes, I think
It's in the slide deck, Leila. We're
yes.
going to
Okay.
share that.
Okay.
By Thursday, you'll receive it
Thank you so much.
along with the
Perfect.
recording.
Excellent. I did hear one. Yeah, sorry. I did have one other question, Alina, from Kenny.
Yeah, that's what
Yeah,
I was going to point towards.
perfect. Yeah, so I wanted to be super precise with the language. So if you have a pre-revenue company, the founders are people who are shareholders and they are employees of that company. So on a purely technical basis, the company should be incurring capital and operating costs before revenues. The founders themselves are separate people, separate from the corporation, separate taxable entity. So in that circumstance, there's not a thing. I think I know what the question is asking though, is in that circumstance, the corporation has no money. The founders put money into the corporation and that's how it works. And then when that's how it works, typically the founders are loaning money into the corporation for the corporation to incur the costs, rent, internet server, travel, whatever they have to do. And so once revenue occurs, then the corporation has these debts to the founders to pay them off. The repayment of those debts are tax-free, as in all payments of debts in Canada are tax-free. But I think from a governance and cash flow perspective, the corporation has to determine what's the priority. Like, do I take this money and reinvest in the business and keep going, or do I take this money and repay the founders right away, like any debt? And that's a governance and cash flow discussion. In my other discussions that I've had with other founders and incubators, I try to encourage the discipline to repay the founders as fast as possible, because I find having those debts outstanding creates a bad habit of organizational cash flow and organizational discipline. And I find, again, from a practical standpoint, from all the clients I've seen, if they have that discipline to repay the founders and really treat the founders and the business as two separate things, it creates a lot more discipline and a lot more structure that they can use that discipline to scale and operate on a more professional basis faster.